This is Alan Henry with HenrySellsHouses.com. We're going to talk now about government allowances. In this world, nothing can be said to be certain except death and taxes. That was said by Benjamin Franklin. When it comes to selling real estate, the U.S. government wants its fair cut of the profits. This comes in the form of ordinary income, if the property is sold within a year of buying it, or capital gains if held for longer than a year. The government allows certain tax advantages so that sellers do not have to resign themselves to forking over a large chunk of money to the IRS. Several of the options of the 1031 should be explored when investing and dealing with real estate. The first option applies only to sellers who sell their property as a primary residence. The IRS will grant sellers who have lived in their home a total of 2 out of the previous 5 years a home tax exemption of up to $250,000 of profit for a single and up to $500,000 of profit for couples. This is extremely powerful because the government is basically giving the sellers free money. As real estate professionals having sold other, and as a real estate professional and as such selling multiple properties for other people, we've seen a lot of clients who want to move into a new house but keep their old house and use it as a rental. Now, on the surface, this makes sense. The mortgage payment's probably low. They've been there a while, paid down some principal on it, so the place is in a good condition financially. It's also in a good condition usually because they've been living there physically, and so the owners evaluate it and decide they'd enjoy a nice cash flow, so they look to rent the property. However, on the other side of it, if you do the math, it makes much more financial sense to rent the house for 2 or 3 years after the move and then sell in order to qualify for the tax exemptions. Once the seller goes past the 2 out of the 5 years rule, the government will want their taxes. Although investment property is different. There is no tax exemption like there is for homeowners, but the government does allow investment property sellers to defer their taxes by rolling profits into new properties. That process is called a 1031 exchange. The IRS tax code section 1031 is where you can find that. A 1031 exchange allows sellers to use funds from a sale of one property to purchase another like-kinded property. So, example, real property for real property. That doesn't mean real property for personal property. And you can transfer those funds without having to pay a capital gains tax. So, in essence, the capital gains are being kicked down the road, deferred, because they will still be due when the property is sold. There is, however, strict criteria around a 1031 exchange. It involves a 45-day timeline and not a single day longer. You have to identify 3 potential properties to buy within a 135-day close period. So 45 days plus the 135 is 180 days in total. The property being purchased must also be of equal or greater value to the property that you were selling. There are 2 major drawbacks in doing the 1031 exchange. The first is that another investment property has to be purchased. Okay, why? It's because most sellers want to get away from landlording. They don't want to get deeper involved into a more expensive property that they have to then look after with the tenants, termites, toilets, etc. And what would be the point if you receive no cash and have to manage a new property? It would be one thing if you could exchange a great new house to live in, but you can't do that, so think again. Not only are you forced to buy another investment property, but because you're rolling the profit from the sale into a new purchase, the government requires you to buy a property of equal or greater value. You will almost certainly have to take on additional debt to finance that new purchase, which means the end result equals more responsibility, more headaches, and more debt. Another drawback is the timeline. The timeline that a 1031 exchange requires is much tighter than it sounds. And that can be stressful because, well, let me say it this way. More times than I can remember, countless times, we've seen people jammed up in identifying the 3 potential properties that they want to buy within that initial 45 days, which really means that they have a property under contract that they have to be certain that they can close on. So they have to identify in that 45 days something that they're going to be certain to close on during the preceding 135 days. In some of those cases, it probably wouldn't be a prudent idea or a wise idea to move forward on that purchase because it's such a rushed experience. You might be better off, or rather off, you might be better off taking the hit rather than close on the wrong property. Closing on the wrong property would suck up a lot of time and energy and money, even more than what it would be worth in a lot of circumstances. The 1031 exchange also can be a time suck or energy waste for these reasons. Now remember, sellers who lived in a property for the last 2 of the 5 years receive up to $500,000 in profit tax-free as a couple, and for singles it's $250,000. The 1031 exchange allows the seller of an investment property to defer the tax obligation from the sale if they use the profits to buy a new investment property. And the 1031 exchange has rigid timelines that are often more stressful than meets the eye. All right, so in the next topic that we're going to discuss is going to be the consequences of idle cash. It's an interesting topic. Be sure to tune in and check out that. This is Alan Henry at henrysellshouses.com. Talk with you later.